Look, today is Monday, June 1st, 2026, and the pre-market tape is completely defying gravity.
It really is. I mean, we're looking at a setup that just ignores standard historical models.
Right, because our mission for this deep dive is to decode this bizarre holding pattern. The S&P 500 futures are actually up 0.22%, sitting at 7,596.
Yeah, right near historic highs.
Exactly. Nasdaq 100 futures are edging higher, up 0.24%, and Dow futures are up 0.13%, crossing 51,099. We are fresh off a 9-week winning streak.
And we are just suspended in the stratosphere right now.
Okay, let's unpack this.
Yeah.
Because to navigate this, you have to look at the two massive forces fighting for the steering wheel today. It's essentially silicon versus crude oil.
Yeah, the silicon catalyst is just pulling aggressively this morning. Overnight at Computex in Taipei, Nvidia's CEO, Jensen Huang, unveiled this massive hardware pivot.
The RTX Spark.
Right, exactly. It's a consumer superchip designed in this big alliance with Microsoft to run local agentic AI directly on Windows PCs.
Wait, I want to pause on the word local there, because that is a paradigm shift. For years, generative AI has been totally tethered to the cloud. You send a prompt to a server farm, they compute it, send it back.
Right.
RTX Spark means the compute happens on the actual physical machine on your desk. That immediately alleviates a massive amount of cloud bottlenecking.
Completely. I mean, it fundamentally changes the latency and privacy math for enterprise adoption. And the market is digesting this hardware cycle instantly. Nvidia is up 1.6% in the pre-market.
And Microsoft is up, 2.8?
Yeah, 2.8%. And it's spilling into Asian markets. It drove the Nikkei 225 over 67,000 for the first time in history.
Wow.
The street is assuming every single Fortune 500 laptop fleet has to be replaced now.
So silicon is pulling us up.
Yeah.
But then you look at the geopolitical handbrake. The Middle East is flashing red.
Yeah, the geopolitical drag is getting intense. We've got renewed U.S. Iran military exchanges, plus these really fragile ceasefire negotiations happening in the background.
Which injects a huge risk premium straight into energy markets. Brent crude spiked over 2% overnight, trading above $93 a barrel. And WTI just crossed 90.
Right.
So what does this mean for institutional flows? Standard mechanics say $93 oil is a tax on the consumer, stokes inflation, and triggers a sell-off. But the S&P is up. How are institutional desks ignoring this energy spike?
Well, they're essentially balancing CapEx cycles against those terminal tail risks. They're treating the tech cycle as an economic shield.
A shield.
Yeah, like an institutional desk looks at $93 oil and sees friction, sure. But they view RTX Spark as validation of a multi-year shift. The productivity gains from local AI are seen as deflationary in the long run.
Meaning they think the silicon supercycle generates enough efficiency to just eat the cost of expensive crude.
That's the bet. They're looking right past the energy friction and throwing capital at the infrastructure.
Which explains where the money is flowing. I mean, looking at these briefing notes, capital isn't flooding into pure SaaS companies anymore. The market is violently front-running physical infrastructure.
The narrative has moved out of theory and into raw manufacturing. It's a full-on sector rotation into the hardware supercycle.
So let's talk about the biggest pre-market gapper here. Hewlett-Packard Enterprise, ticker HPE. They report Q2 earnings right after the bell today, and the anticipation is wild.
Oh, it's aggressive.
Up 2.9% pre-market, trading near $44.32, up to $46. Closed Friday at 43.04.
And look, the momentum behind HPE today is purely a sympathy trade based on what Dell did last week.
Right, Dell's $16 billion AI server revenue.
Exactly. That number proved enterprise clients are actually signing purchase orders, not just talking about it.
But here's where it gets really interesting. If everyone is blindly buying HPE because of Dell, aren't they ignoring a massive structural vulnerability?
The supply chain.
Yeah. HPE has a $5 billion AI server backlog. But a backlog is just a promise until you ship the product. If they can't source the components, doesn't that premium just vanish?
It evaporates the second the call starts. And the specific bottleneck is high bandwidth memory.
HBM.
Stacking multiple DRAM chips, microscopic connections, the manufacturing complexity is insane, and global yield rates are so tight. Dell somehow secured enough packaging supply to hit that $16 billion.
And the market is just assuming HPE has that exact same supply chain leverage.
Which sets up two extremely volatile scenarios into the close. The bull case in the notes needs a clean beat and proof of secured memory. If they get that, initial target is 46.50. Breakout pushes it toward 48.50 to $50.
And the bear case.
If they admit HBM bottlenecks are squeezing margins, the stock could plummet back to the $38 to $39 range.
It's all execution versus expectation. The market is demanding physical execution. We're even seeing this on the software side. Look at ServiceNow, ticker NNOW.
Surging 3.57% pre-market.
Right. Not because of a broad language model, but because of an expanded agentic AI partnership with Wipro. Specialized, task-oriented agents. Generalized AI isn't enough to catch a bid anymore. You need applied tools.
Application is the theme of the tape today, and that demand pushes us beyond server racks. AI is literally hitting the pavement.
Let's pivot to vehicular tech. Uber is up 1.4% to $71.40 pre-market.
Yeah, that action is driven by their partnership announcement with Autobrains and Nvidia. They're deploying a level 4 robotaxi fleet in Munich later this year using Nvidia's Drive Hyperion platform.
Nvidia is the backbone again. But structurally, this is huge for Uber, transitioning from human drivers to an asset-light autonomous platform. Remove the driver, the margin profile fundamentally changes.
It does. And tactically, if buyers defend this momentum and clear resistance at 72.50, the order book opens for a run to $75.
But what about European regulators? Munich authorities are notoriously strict on autonomous testing.
Variable.
If there's regulatory pushback, that premium collapses, right?
The notes explicitly flag that. A delay triggers a drop to 68.50. Again, physical execution. Flawless software doesn't matter if the cars aren't street legal.
Which brings us to the ultimate execution challenge, raw manufacturing volume. NIO is a prime example, up 2.5% pre-market, trading at 5.74.
NIO's May deliveries were staggering, 37,705 vehicles.
That's a 62.3% year-over-year surge.
Yeah, it shows the ONVO L80 and flagship ES9 are finally clearing those old bottlenecks.
Institutions wanted proof at scale, and 38,000 units in a month is proof. But they are operating in a brutal pricing environment.
The Chinese EV price war is literally attrition, slashing margins just to bleed out the competition. And tactically for NIO, breaking 6.10 confirms a trend reversal towards 6.50.
And the downside.
If sector weakness drags it below Friday's low of 5.36, we could see algorithmic selling down to 4.40.
So, synthesizing all this, Nvidia chips, HPE hardware, Uber robotaxis, NIO scale institutional money wants hard assets moving in the real world.
Pricing in the physical build-out of the decade.
But here is the massive warning flag in the briefing notes. Despite these corporate wins, the macro section calls today's market a liquidity trap. We're going to look at the overlay the retail sector is fatally misunderstanding.
Because the macro scoreboard is toxic today.
Yeah, Ray.
U.S. 10-year Treasury yield is spiking to 4.47%. The dollar index is firming up to 99.03. Core CPI is sticky at 4.1%.
Let's walk through the mechanics. A 4.47% risk-free rate structurally compresses equity risk premiums. Institutional models discount future tech cash flows using that 10-year yield as the denominator.
So the yield goes up, present value of tech earnings shrinks.
Right. Plus, a 99 DXY destroys foreign revenue margins for tech giants. Their products get more expensive overseas. By the textbook, this should crush the rally, yet the Nasdaq is grinding higher.
Which is the core psychological trap right now, the pain trade. Retail investors see the 10-year yield, they see $93 Brent crude, and they short equities.
Betting heavy against the rally, short interest across the U.S. and Canada is at a record $2.13 trillion.
Trillion, yeah. But retail is completely misreading the institutional view. Large funds aren't treating AI as a high-risk growth play. They're treating it as a safe haven.
Wait, secular AI as a safe haven?
Yeah, they believe the growth outpaces the drag of a 4.47% yield.
It's like a backwards pressure valve. Retail shorts try to push the market down, but every time underallocated funds buy in, like Goldman Sachs, hiking their S&P target to 8,000, the market ticks higher.
And the retail shorts bleed.
Exactly. They get squeezed, forced to buy back the stock to stop losses, which pumps synthetic buying pressure into the exact rally they bet against.
That's the pain trade. The market inflicts maximum damage on the consensus position. Institutional capital faces career risk if they underperform, so they chase tech regardless of the macro data.
Okay, so if you're navigating this trap today, you need exact lines in the sand. Let's hit the technical pivot so you know where order flow flips. Starting with S&P 500 futures.
The definitive S&P pivot today is $7,595.00. Below that, the trap springs. It signals buyers step back, opening a rapid flush to 7,572.75, targeting $7,530.
And if they hold the line.
If bulls clear the all-time high resistance of 7,611.50, the trap is invalidated. Triggers more short covering, targeting $7,625.
Got it. And the tech-heavy Nasdaq 100.
The line for the Nasdaq is 30,330.000. A breakdown exposes it to 30,216.60 in Waller, potentially down to structural support at $30,120.0.
But on the upside.
Bulls have to clear Friday's peak of $30,536.00. If they do, the target is $31,000.
So, bringing this all together for you, if you're managing your own portfolio today, what's the fundamental takeaway?
Stop fighting the tape with outdated playbooks. Secular AI leaders have the pricing power to absorb a 4% plus yield right now. Shorting this based solely on inflation fears is highly destructive.
Top over hedging. Respect the institutional flow into physical infrastructure.
But keep an eye on risk. The briefing notes issue one final warning on the 10-year yield. The absolute ceiling to watch is the May high of 4.67%.
Because if we cross 4.67,
the math fundamentally breaks. Gravity turns back on. We'll see severe volatility as models recalibrate, but until that level breaks, every single dip is being bought.
it's a fascinating tape to watch. We started by questioning how the market stays suspended while the macro foundation cracks. The answer is that the foundation is being completely rebuilt on silicon.
Exactly.
Which leaves you with a massive forward-looking question to mull over as the bell rings today. If institutional money is treating high-growth AI stocks as a literal safe haven, ignoring a 4.5% risk-free rate, does that mean the traditional 60-40 portfolio of stocks and bonds is dead forever? If tech is the new bond, what exactly is going to protect our portfolios when a real recession finally hits?